Welcome to today at the A4S Summit. The theme for today is measuring what matters. And one of the areas that is, of course, important to understand how to measure and how to value is climate risk. Members of our CFO Leadership Network based in Canada have been grappling with this issue, and I'm really pleased to be announcing the launch of the latest A4S Essential Guide series, which is embedding climate risk into the heart of valuations. We have a lot of pension funds and asset managers in our Canadian chapter, and they've worked with a number of other organisations around the world to produce this guidance and help all valuators and others in the financial world to understand and embed climate risk into the heart of how they value assets and companies. So I am delighted to introduce David Mcgraw, CFO of Ontario Teachers Pension Plan, who has chaired this project, and he will introduce our fantastic panel for today.
Thanks, Jessica, and welcome to the panel discussion on the impact of climate change on business valuations. Before I introduce the panelists, I would like to touch on why we decided to produce the guide, what was the motivation behind it, and what is the link between valuations and climate change. The impact of climate change is an increasingly important consideration when making investment decisions and determining the value of businesses. At the Ontario Teachers Pension Plan, a substantial portion of our investments are in private assets, including direct investments in private equity, infrastructure, natural resources, and real estate. So that is why business valuations for our private investments are very important to us, both for financial reporting purposes, but also to inform our investment decisions. Climate change and business valuations are inextricably linked. So when determining the value of businesses, we have to consider all the risks and opportunities, of which climate change is one. In 2019, we started thinking more deeply about how to reflect the impact of climate change risks on the valuations, and we did a scan of various valuation organizations around the world, and surprisingly, found that there was very little guidance available. So this lack of guidance highlighted the need for a valuation framework to facilitate a consistent approach to factoring in climate change risks into valuation and investment analysis. This led me to approach A4S and CPA Canada with the idea of creating some guidance for investors, valuators, and other key stakeholders. I was very pleased that A4S and CPA Canada were enthusiastic. It was on that basis that the impact of climate change on business valuations working group was formed and the guide has been developed. We recognize that factoring valuation into climate change is in its infancy, and through this guide, we hope to inform discussion among the valuation, accounting, and regulatory communities to encourage moving this topic forward into accepted practice. By doing so, we would expect more robust disclosures in corporate reporting and greater oversight by boards on this topic. We hope that the guide will become widely referenced and used by valuators and investors in their valuations and decision-making processes. So I'm delighted that many of the organizations that are part of this working group are here with me today, and I would like to introduce the panel. Marika Paul, EVP, CFO, and COO from the Caisse de dépôt et placement de Québec, also known as CDPQ. Jonathan Simmons, CFO of OMERS, and Brian Lawson, Vice Chair of Brookfield Asset Management. And unfortunately, due to scheduling conflicts, the New Zealand Super Fund, who are also key contributors to the working group, were unable to join us on the panel today. Nick Talbot, the CEO of the International Valuation Standards Council, or IVSC, is also with us today. We're very pleased that the council was involved in the technical review of the guide that the working group developed. Now moving on to the panel discussion. The guide introduces a practical framework for integrating climate change risks and opportunities to valuation. We refer to this as the 5-step framework. The framework outlines the following key steps. The first one is identify, which is really identifying the key value drivers. The second one is assess the source of climate change risks and opportunities. The third one is called filter, so it's filtering for risks and opportunities that are more significant and more likely to occur. The fourth one is integrate, integrating the key risks and opportunities into the valuation. And lastly, triangulate. Triangulate these to market observations and iterate as required. So let me turn to the panelists and get their thoughts on how they're currently considering integrating the five-step framework in their valuation and investment analyses going forward. So Brian, perhaps we can start with you. Identify is the first step in the framework, which sounds pretty basic, but interested to get your thoughts on the importance of the first step of the framework.
Thanks, David. And I would agree that that first identify step does indeed sound basic, but getting this step right is anything but simple and really sets up the rest of the valuation process. This involves identifying the key activities and variables that drive the value of a business. And getting that right allows you to focus on what really matters in assessing the value and developing your due diligence strategy and underwriting models accordingly. For us at Brookfield, and like many others here, we're typically in a control position, and that allows us to use our deep operating capabilities to affect change. That's a big part of our strategy to add value. And also, this step identifies us to identify what we can do to enhance value during our ownership. Climate change adds a newer set of opportunities and risks that can affect all of these activities. So it's critical to get these into the mix as well. And this is particularly important for us and others, like as David mentioned, a lot of what we own and manage are physical assets such as real estate and infrastructure and renewable power. And these all have an impact on and are impacted by climate change.
Well, thanks, Brian. Certainly identifying the company's key value drivers is a fundamental step, and getting the first step right is anything but simple. Jonathan, as you know, the second step of the framework is assess, and just what are your thoughts on how owners and others might assess and determine the key climate change risks and opportunities relevant to a particular investment?
Well, hello, everybody. David, I like to think of the assess phase as the phase where you're actually beginning to develop that point of view. So what we find is it's helpful to have a tool and a methodology to do that. You know, at OMERS, we have investments in over 25 different countries. We've got investment teams on 4 continents. And so having some consistency in the way we look at this is really important to us. So we have a checklist, sounds pretty basic, but it's very effective that we use to assess ESG factors. And so it's pretty broad in its scope, but specific to climate change, it asks questions like, you know, does the company that we're looking at have an effective strategy, including a clear identification of the risks and the opportunities that climate change presents? Think about things like the supply chain. Is the company prone to events in the supply chain relating to climate risk? Does the business plan think through what will happen in a 2 degree or a 1.5 degree world in the future? And you know, is the company providing adequate disclosures using the TCFD framework? So those are what I think of as the inside-out factors, the ones that you get during the due diligence process, when you're meeting with the management team, when you're reviewing company data and asking questions. But there's also the outside-in approach, which is what's out there in the industry, what data sets are available about the sector that we're looking at, what work have researchers or consultants done that we can also look at, so that we can triangulate what we see from the data room due diligence and the management interviews with what we know and see out there in the market. And TCFD classifies the climate-related risks really into 2 buckets, and it's helpful to think through those. The first are what are the factors and risks relating to the transition to the low carbon economy. Those are things like government policy and legal risks and the technological barriers to change. And then the second one is the risks related to physical impacts like weather change or rising sea levels. And we look across these dimensions. So I really encourage people to pull out the guide. It's got a handy appendix. The appendix sets out the risk categories, breaks them down into a little bit more detail. And I think there's a lot there certainly we found it helpful to owners, and I think there's a lot there for everybody.
Well, thanks, Jonathan. Really appreciate that response. And filter is the third step of the framework. I'm going to ask Marika, what are your thoughts on some of the challenges that you anticipate CDPQ might encounter in the filter step, and how do you think those challenges might be overcome?
Well, thanks, David. As part of our investment decision-making process, in fact, every investment at CDPQ goes through our climate and ESG filters at the investment committees. And in order to achieve our climate change goals, each investment team gets an annual carbon intensity budget, so tons of CO2 emitted per $1 million invested for their respective portfolio. And every new transaction has to fit into that allocated budget. And that's how we engage all our teams to reach our carbon intensity target. And by applying these filters, we were actually able to reduce carbon intensity of our portfolio by more than 20% over the last 3 years. And these same filters are considered to ensure that we take risks and opportunities into consideration and assess both their likelihood and their materiality in the valuation process, both for existing assets, but also for potential acquisitions. And like Brian mentioned, assessing the materiality of their impact and their likelihood is a continuous exercise. So as a concrete example, we support a company in the electricity production sector, which is transitioning from fossil fuel to cleaner sources of energy production. And in this case, CapEx and additional revenues related to the transition were identified as opportunities. And we assessed those to be both material and very likely, since they were approved by the regulator. And so considering that a market participant would include this opportunity in their investment case, we decided to reflect it in our fair value. And the same thing would be true on the risk side. So always looking at, whether regulatory constraints on certain assets might, impact future values.
Those are great examples, Marika, and that takes us to the fourth step of the framework called integrate. Perhaps you can provide a bit more color as to how one would go about integrating these considerations into a valuation analysis.
Well, first off, valuation is always performed from a market participation point of view. And so the first step is to consider whether a long-term investor would consider climate risks in their valuation. If they do, the next step would be to determine how the cash flow profile as well as the terminal value could be affected. If there is, in fact, not enough information to make these adjustments, but there are nonetheless potential climate risks, we might use a higher discount rate in our valuation work. So currently, we incorporate likely opportunities and risks mainly by adjusting cash flows and terminal values. And those opportunities or risks are not included in valuation when the probabilities are too low, there's too much uncertainty, or as I mentioned before, they're not considered by market participants. And where we do have good visibility, well, we do adjust the terminal value according to the long-term outlook. So for example, in the wastewater treatment industry, we're comfortable using a higher valuation terminal value multiple, considering that companies and municipalities will be more and more sensitive to treat their water to limit their footprint going forward. And the same would be true, for example, for the electricity production sector, where we would reflect the conversion of the production to greener energy in the terminal value.
Well, thanks, Marika. That's a great description. And last, but certainly not least, is the last step of the framework called triangulate. And Brian, you kicked us off with the first step of the framework, so it's only fitting that I ask you to close it off. Just what are your thoughts on the importance of this final step of the framework, triangulate?
Sure, I'd be happy to, David. So as you've just heard from my fellow panelists, the first 4 steps of the framework are really key to determining the internal value. But we can't lose sight of how the broader market ascribes value to the same or similar assets, because at the end of the day, that market value does drive what you can sell it for. It certainly has a big impact. So accordingly, a big part of the framework is to tie those 2 concepts together. The relationship between the two is critical to achieving your returns. So at Brookfield, like a lot of other active owners, we're really focused on building that internal value. But we recognize that many of our strategies require us to eventually sell the asset and return the capital to our investors or reallocate it to other opportunities. And that's where the market value comes into play. So for example, it's really important to understand what sort of premiums or discounts apply to various markets and how those apply to the internal value. And it's also really important to understand how value metrics today might evolve over time, particularly for long-term investors like us. So climate change, you can see that already having an impact on these. So understanding all of this enables you to better invest for value at the outset and also get that optimal exit price. And all of this, of course, leads to better portfolio management decisions and better returns.
Thanks, Brian. And hopefully this discussion provides our audience with a better sense of how the 5-step climate change framework can be used in practice and incorporated into valuation analysis. I would now like to ask the panelists for their various views and thoughts on climate change issues, leadership, and the relationship between climate change, risks and opportunities, decision-making, and valuations. So Brian, developing this guide took many months and reflected a significant investment by all the contributors to the working group. Can you tell us a little bit why Brookfield chose to participate in this project and development of this guide?
Yeah, of course, David. There were two primary motivators, but they made it quite an easy decision to get on board. So we're delighted when you and A4S and CPA came forward with this. So the first one for us is, I think for all of us, is, and as you acknowledged at the outset, getting climate change properly involved and incorporated into valuations will have a significant impact on how capital is allocated throughout the investment chain and help guide it towards the investments with the best climate outcomes. We believe in the vision of A4S and Israel Hannes in this regard, and this is one of the key reasons that Brookfield has been part of A4S for a number of years now. And secondly, this topic is fundamental to our business. We provide regular valuations of virtually all of our investments to our institutional investors so that they can assess the performance of our private funds. And we also carry many of our assets at fair value in the financial statements of our listed entities. We have to get the climate change factors properly integrated in our valuation so they can be based on the best and complete information. And also as an asset manager, as we've discussed, having a thorough understanding of the internal and market value helps inform our investment decisions. This helps us buy for value, but also sell at the most opportune time. As an example, we've incorporated carbon pricing into the underwriting models of our renewable power assets for something like 2 decades now to help us think about how pricing and margins could evolve. But as the impact becomes more real and present for a broader range of investments and businesses, we need to take these additional risks and opportunities into consideration across much more of our business.
Thank you very much, Brian. And at Teachers, we share a similar view. And our goal with respect to climate change is to successfully manage the pension plan through the transition to a low carbon future and ensure the plan remains sustainable for current and future generations of our members. And just to highlight some of the recent work that we've done. So last year, we published our first standalone TCFD aligned climate change report. Additionally, we increased the scope of our carbon portfolio footprint by actually incorporating our private assets. This year, we formed a new strategic relationship with Wellington Management Company and Woods Hole Research Center to advance physical climate risk and opportunity management. So Marika, when it comes to climate change, CDPQ is a leader, for example, setting a net zero target emissions for your portfolio and being a founding member of the Net Zero Asset Owners Alliance and aligning your investment strategy with your climate goals. So Marika, how did you set your zero target goals and targets, and how would you work to align your investments with this target?
Thanks, David. CDPQ has played a pioneering role and continues to provide key leadership on climate action. We implemented a climate change strategy in 2017 after probably over 18 months of thought went into it. And our goal now is to reach carbon neutrality by 2050. We were one of the first investor groups actually in the world to prioritize the issue, as well as to publish targets on carbon intensity and carbon neutral assets and our progress against them, because we believe that what gets measured gets done. And for this same reason, we also tied our employees' compensation to meeting those targets, just as they have to respect their risk budgets, just to make sure that everyone took climate change seriously. We also have our auditors prepare a limited assurance engagement on our numbers, and we follow our progress with regards to climate related financial risk disclosures against the recommendations of the TCFD. And to reach this goal, we engage actively with our portfolio companies and engage with our peers with associations, as you mentioned, such as the Net Zero Asset Owner Alliance and the Climate Action 100 Plus. We believe that our collective influence has an impact. And furthermore, we created a responsible investing team. We beefed up our expertise in our risk team as well to help. We encourage companies in our portfolio to set ambitious sustainability objectives and reduction emission targets. We also recommend that they use ESG criteria, the TCFD framework, or SASB norms, in fact, to transparently disclose their results. And we share with them findings and initiatives to facilitate the assessment of their performance and positioning in relation to their peers. And we vote on climate change proposals at shareholder meetings, etc. So we believe by engaging our network, all of our network on climate change, we actually will facilitate the transition to a more sustainable economy for all.
Marika, thanks for sharing that. It's clear that CDPQ has made very significant progress on sustainability over the last several years. Factoring ESG and climate change considerations into decision-making across organizations is becoming increasingly important. At Teachers, responsible investing in climate change governance begins with our board and extends through every level of the organization. For example, we have a climate change working group, which is a cross-departmental group that informs teachers' approach to climate change, advises on change metrics and analytics, and more importantly, champions climate change awareness across the organization. Jonathan, I'm curious to know what OMERS is doing today to incorporate ESG considerations, and more specifically, climate change, into investment and asset management decisions.
David, I looked back at some of the history of OMERS, and we've been integrating ESG factors into our investment decision process for many, many years. But I think it's fair to say that like others, that the pace and intensity of that review as it relates to climate has really begun to pick up in the last little while. Like you, it starts with our board of directors. We have a very clear policy that establishes that ESG must be looked at. But we've evolved. We haven't stayed static. So we took a very broad policy, and a couple of years ago, we formalized that into a much more targeted sustainable investing policy. And that requires that we integrate ESG factors into the decision-making process. And I think that we've got better at that as we have had practice and as we've developed our tools to enable teams to do it. And we've become much more standardized across our various business units. The second thing is that we are actively engaging with our portfolios in a much more intense way than we have in the past. And whether that means voting our shares of our public investments or the work that we do as we sit on the board of private investments, that level of conversation now is much more targeted and much more informed. So that's evolving. And then the final area that I think is changing is the level of collaboration that we have with others, like those of you on this panel today, to exchange information, to learn from each other, and to advocate for better transparency in everything we do and everything that the organizations in which we invest do. And this is really important to OMERS. We're a pension plan. Our youngest member is 15 years old. Our oldest is 108. So we measure time in decades, not quarters. So when we talk about investing for the long term, it's really real to us. And that means that in order to liquidate the pension promise, we have to find investments which have long-term stable returns. And so identifying the climate change risks and opportunities that each of our investments have is really important to us. And we don't have all the answers, but we're making progress. So, when I listen to Marika describing, risk budgets being allocated and reducing carbon intensity, that's very sophisticated. We're not quite that advanced yet, but we have in the last year been really working hard on calibrating our carbon intensity, and we've learned a lot as we do that. And so we're just in the final processes of that exercise right now, and that will allow us to become even more ambitious about what we do next.
Well, Jonathan, it's quite a journey, isn't it? And what you described is very impressive. So it's clear that climate change is a risk that we need to act on immediately. And A4S's strapline or tagline, as we typically refer to in North America, is about making sustainable businesses business as usual. And it's clear that standards have a role to play in codifying practice into processes. So Nick, the IBSC has been very supportive of the development of this guide, including the involvement in the technical review. And now that we're publishing the guide, can you provide your thoughts on the importance of this work?
Thanks, David. I think the framework that you've all developed, it represents a significant step forward in terms of systematically incorporating climate change factors into valuation. And I think it's something that should serve as an example for broader consideration of ESG factors. I've been particularly impressed with the level of commitment that there is from major investors in this initiative. And I think that the world needs leadership in relation to climate change, and investors and A4S can make a significant difference by helping innovate to factor climate change into valuations and pushing those changes in what is expected and required in relation to the investments you make around the world. And for me, I believe this is not only the right thing to do, which will ultimately have a positive impact on climate change, but it's the right thing to do in terms of trying to make good investments by quantifying as much as possible the impact of climate change on a particular investment. So I think this is a really good start to the journey. I think it's important to keep developing and advancing this work as we learn more, and also making it available for different stakeholders to utilize as much as possible around the world so that it can have as much impact as possible.
Well, thank you, Nick. And we really appreciated the support and encouragement of IBSC as we develop this guide. So many, many thanks again. And Brian, I'm curious, how does Brookfield handle making investments in what many would say is still a transition period, and before full information is known about the potential impacts of climate change on an investment?
Sure. Well, that's a really important question. And as we all know, there's always lots of unknowns and risks when you're making investments, and particularly when you're investing large amounts of capital in physical assets with a very long time horizon, like each of our organizations does. So much can change over that time. Here's how we think about it. We've always been focused on long life, high quality assets and businesses that form the backbone of today's global economy. We believe that protects value and generates reliable returns. But at the same time, those very same characteristics require us to be very thoughtful about what can change over that time and making sure that we're prepared to withstand and adapt. We think having the strong operating capabilities and hands-on approach puts us in a good position to do that, but it does require being very disciplined about thinking forward to these sorts of things. For example, I mentioned earlier that we've been incorporating carbon pricing into the valuation of our renewable power assets for some time now. Candidly, we didn't really know how carbon was going to impact pricing and how that was all going to play out when we first started. But we did feel it was important to incorporate this, get it on the table to ensure that we kept thinking about what could happen as governments focus more on energy production as a way to reduce carbon footprint. We've now built climate change assessment, as a number of us have, into virtually all of our underwriting processes. And this goes right up to the investment committees, not just the risks and opportunities at the outset, but our plans to execute on those during our ownership. We may not have all of the answers, but at least we consider the possibilities and endeavor that ensure we're well positioned to deal with them as we go forward.
Those are great examples, Brian. Thank you very much. Getting perspectives from both the accounting and valuation communities is of key importance. And Marika, as well as being a CPA, I understand you're also a chartered business valuator. Why do you think it's so important to embed climate risks into the valuation process?
Well, we started, as I mentioned before, on the climate change journey over 3 years ago to ensure a sustainable future, since the threat associated with climate change was growing. And we believe it's a major risk to our communities and to our assets. But we also felt that it was a way to get our investment teams to focus on opportunities that new technologies and ways of operating could bring. And all of this is obviously increasingly having an impact on the valuation of an investment. And it's interesting to make the link between the role of CPA and CBV. CPAs wear brown socks and provide, relevant, accurate, and reliable financial information, including disclosing fair value of our investments to our stakeholders. But to do so, they can now rely on the expertise of CBVs to ensure that the fair value disclosed is representative of market participants' considerations. And so as capital markets begin to integrate climate change into valuations, CBVs are also reflecting climate change in the fair value. And that way, investors can make more informed decisions when climate change risks and opportunities are taken into account in valuations. And for all of us as asset managers, where we have to provide, we don't report on a cost basis, we report on a fair value basis, that's critical. And a company that's aware of its exposure to risk will be more resilient in the long term, we believe. And if adapting to climate change is incorporated into its strategy, then that as well obviously provides value. And at the end, as Brian said, the goal is to provide greater returns to shareholders, and that's why it's important to reflect the climate risks and opportunities in the valuation process.
I agree, Marika, and I think it's only a matter of time until climate change risks and opportunities are more explicitly priced into business valuations. In fact, it's becoming evident today that companies in climate-friendly public market sectors and those companies that have high ESG ratings trade at higher multiples than their peers. So, Jonathan, interested to get your thoughts on what some of the advantages might be to addressing climate change risks and issues early, so there may be opportunistic scenarios for deal teams to acquire or divest of assets.
David, as I reflect on the world of investing, it always strikes me how easy it is to fall off the efficient frontier. What we do as investors is getting increasingly difficult in the current environment that we're in, and therefore, every ounce of return that we can identify and seek is a source of competitive advantage to us. So I think those of us that are able to get in early and isolate these risks and probe deeply into them will have an advantage, because it will help us to spot some of the issues that lie ahead, and it will also enable us to spot the opportunities to go after and price and pursue. And I think the work that we do early reinforces every aspect and every element of the investment chain. So the work that you do around valuation informs your approach to asset management. The experience that you learn from asset management gives you insight into the opportunities that you should be seeking for investment. And putting that all together enables you to think about, well, when is the right time to sell an asset? Because at the end of the day, we pay pensions with dollars, and we have to generate the cash to pay pensions. And so really that entire life cycle becomes self-reinforcing, and getting in early and thinking thoroughly is something which is very important. And the other observation that I have is that I don't think it's lost on any of us that the costs of transition to a low carbon economy are only going to get bigger as time goes on. And because we're in the investment business, every dollar of cash that we generate, we put a multiple on. So there's a magnifying effect of this on value. And so getting in early and placing that focus on this area, I think, is critical to us as long-term investors.
Jonathan, those are really interesting observations. Important progress towards improving corporate disclosure made in recent years, and many organizations across the globe have been working to improve climate change disclosures in financial statements and corporate documents. And over time, it's expected that such disclosure will continue to improve and become more widespread. So we should also discuss the importance of an internationally recognized body providing a stance on a key issue such as climate change, as it could have significant implications to how other regulators around the globe set guidelines and requirements. So, Nick, I just wonder what your thoughts would be on the guide and how it might impact IBSC's guidelines or standards in the future, and what might the impact be to financial reporting standards as well?
Thanks, David. Big questions. So from an IVSC perspective, we've recently issued an agenda consultation on how our standards should evolve further. That's open until mid-January, and if anyone wants to give input, please go to our website and do that. We welcome the best ideas from anywhere in the world, both consultations and as we actually evolve the standards. Whilst our standards do already incorporate some components, we expect that climate change and indeed the wider ESG components to factor heavily in the evolution of our standards. What we've been doing is we've been drawing together existing information that's already out there, much of which is qualitative, but we'll then be focusing on how we can quantitatively assess the impact of factors such as climate change. As part of that, we will specifically look at this guide as part of that and take it into consideration. And we'd welcome participation in our working group on the topic too. If there are any experts out there that wish to participate, just get in touch. Ultimately, IVS are principles-based standards and don't go into the same level of detail. But it's important to us that there are initiatives which align with IVS principles and develop more in-depth guidance. And I think that's the way that we can work well together in advocating a globally consistent approach to valuation through both IVS and a more detailed approach to factoring in climate change through more in-depth guidance such as what you've put together here. Adoption and use of both IVS and guidance such as this is just as important actually as the development if you want to have a true impact in the fight against climate change. And we'll be happy to give the framework profile to help achieve that goal. On the financial reporting point that you mentioned, I think it's likely that in the not too distant future, we will see a sustainability board alongside IASB. I know from our relationships with them that they're very collaborative, and I'm sure they'll want to take into account both the work we do as well as initiatives such as this. From my point of view, ultimately it's really important that climate change is adequately considered in financial statements, as that's what's going to both give a truer picture of the financial situation of the company and equally importantly help drive much better business behavior in our fight against climate change.
Well, Nick, thank you very much for that. And we certainly look forward to staying in touch with IVSC going forward as we continue these discussions. So climate change considerations are important to many stakeholders, not only valuators and investment teams. So Brian, what are some of the things you're hearing from your key stakeholders with respect to the consideration of climate change as it relates to your investments?
Well, David, it's certainly increased over the last few years. We interact with hundreds of stakeholders around the world. Climate change and ESG more broadly is a top priority of virtually every organization we deal with, and I'm sure all of us here today are seeing the same thing. Not surprisingly, we've probably seen the most active engagement amongst our investors, particularly in our private funds, but increasingly with our publicly listed vehicles as well. I'd say the sheer scale of our operations, particularly renewable power and real estate, means that we can have a positive impact at a very large scale. And that means that investors want to know what that involves and what we're doing about it. I'd put the interest in three broad categories. The first is telling them how you incorporate climate change into your decision making and reporting on those activities. And that's whether it's positive or negative. To that end, we've joined the SASB Alliance, become a signatory to PRI, and are moving towards aligning our climate-related reporting to TCFD. Second is demonstrating that you are having a positive impact and showing the improvement in that regard. I'd say an example of that in our case is of our response is providing emissions reports that track the progress and impact of our renewable power operations in lowering carbon emissions. And third, they want to know what opportunities that you can provide so they can have an impact. In our case, we've now issued more than $5 billion in green fixed income securities. And we've announced the launch of a series of impact and transition funds, and we're thrilled that Mark Carney has joined us to lead this initiative. So those are some of the ways that we've tried to be responsive to the sorts of things that we see our stakeholders asking of us.
That's great progress, Brian. So there's various reasons for the present lack of quantitative analysis around climate change in current business valuations. And our guide includes some excellent case studies showing real-world applications of the framework to investment considerations, despite the shortcomings in the availability of information. So Marika, I'm interested in getting your thoughts on the inclusion of case studies in the guide, and perhaps any lessons learned that CDPQ or others have gained from working through the case studies that are provided.
Thanks, David. Personally, I think, theory is always nice and principles are nice, but at the end of the day, you kind of want to know what are others doing and what, how do you deal with this in real life? And so I think the case studies actually, show practical ways of dealing with this, particularly because investors are facing different industries, different contexts, etc. So, the guide illustrates how climate change risks and opportunities can impact fair value in various ways. And so there are real lessons learned. And these include things like the importance of acknowledging the fact that climate change can bring as much opportunity as risk, and that both should in fact be assessed in fair values. We also learned that quantifying the impacts of risks and opportunities isn't always possible. It sounds simple enough, but it's not. And sometimes it's going to, as I think Brian mentioned before, it's going to evolve over time. We publish, carbon intensity, et cetera. Well, when we first set out to do it, there were no rules around it. Nobody did it. So we kind of determined this was how we were going to do it, and we refine it, and it'll change over time. We also noted an important limitation in the case studies that, you can only incorporate into fair value the risks and opportunities that would be considered by market participants if you're, wanting to value things. And there's a large element of professional judgment involved in incorporating these risks and opportunities. And finally, integrating climate change factors, as I mentioned before, continues to be an evolving process. We'll get better and better at this as sustainability reporting improves, as things get more accurate, as we get better numbers, and so on. So stay tuned, because it's going to keep changing.
David, I'm with Marika on this. We didn't get involved in this either out of just intellectual curiosity. We did it because we have a real practical interest. At OMERS, half our balance sheet is invested in private market assets that you can't look on a screen to value. So this is really important to us. And so for me, the examples in the document were really helpful, because it's fine to develop a framework, but it's when you put it in practice, it really reaches the test. So a couple of observations that I would make. I think, as we all know, valuation is at its most credible when we are most comfortable with the quality of the assumptions, and when we can corroborate the metrics against third-party information, and that's still really hard. And when you read the guide doesn't shy away from that. It actually points that out, and that's the reason why we need to contribute to better data as CFOs, and that's the reason why we need to embrace TCFD and get the disclosures right, because it's only as we build that data set that things are going to improve. And the second thing that I really got from looking at the practical examples is it's really easy to be glass half empty on this stuff, but there really is opportunity. And so the guide brings out the glass half full very clearly, and I really like that.
Well, Jonathan, that's a great segue. So CFOs are no longer limited to just financial reporting matters and play an increasingly important role across the organization. So just interested in how you think about the CFO role and how it can support climate change considerations across organizations and the industry more generally.
Wow, that's quite a question. As CFOs, we're the stewards of the balance sheet. So we are desperately interested in the operating, investing, and financing cash flows of the businesses that we are stewards of. And for me, it's really about three things. And I would encourage everybody who's listening to think about three aspects. As CFOs, we need to speak up, we need to adopt, and we need to contribute. So because of our position in the companies and organizations that we have, people will listen when we speak. So I'm really proud that OMERS, the CEO of OMERS, and 7 other leading Canadian pension plans recently issued a joint statement calling on companies, investors to provide for consistent and complete ESG information. But as CFOs, we need to advocate for that too. We need to adopt. And that means if we haven't signed up for TCFD yet, we need to do it. And it's hard, it's not easy. People are hesitant about the disclosures, but if not us, then who? So please, ladies and gentlemen, can we agree to put our shoulder to the wheel and get on with it? And then the final thing is contribute. If we want better data and we want to get better at the valuations, then frankly, we have to give a damn, which means that we can't just take, we also need to give. So contributing to that data is really important, because it's only when we do that, it will get better. And so we need to take some measured risks personally and professionally to stick our neck out and to stick the neck of our organization out, to do it in a very sensible way. And so at OMERS corporately, just like you heard Brian make comments on Brookfield, we get involved. We're a founding member of the Investor Leadership Network, which is a platform which leading investors have established to really address climate change issues. We're a signatory to TCFD. We're a member of the SASB Alliance, and we recently participated in an IFRS consultation paper on sustainability reporting. So speak, adopt, and contribute.
That's great, Jonathan. Thank you very much for that. And I'd like to thank Marika, Brian, Jonathan, and Nick for their participation today. And of course, a special thanks to A4S and CPA Canada for their sponsorship. I'd also like to thank the working group for their significant effort and contributions to creating the guide. The guide will continue to develop in the future as valuations, investors, regulators, standard setters continue to see the importance of incorporating climate change risks and opportunities into their valuations and decision-making, and as information becomes more widely available. We hope that the guide becomes widely adopted and is informative for the valuations and investment community. So thank you all for joining us.